You're about to lose everything because of the system's big lie. While you're holding your breath for another 2008-style financial collapse, it's already happening. In the dark, out of sight. The government will tell you inflation is just 3%, that everything is stable, that the economy is holding strong. But if you're in the bottom half, you already feel the gap between what they say and what's real, because your reality isn't 3%, it's closer to 9%, and it's getting worse. It's all thanks to a shadow banking system holding $2 trillion hostage with accounting techniques that would have you doing hard time in federal prison. When the crash hits, it won't look like 2008. It'll be quieter, faster, and by the time you realize what's happening, it'll be too late to protect yourself. This is the real reason the economy hasn't collapsed yet. Part 1. The Great Disconnect. You and the investment class are living in two different universes. The S&P 500 looks pretty healthy right now, reaching record levels. But you've got as much a chance to get on the property ladder as you do climbing up a magic beanstalk. According to Fortune, U.S. mortgage rates are at around 7%, and you need to be earning at least 6 figures if you want even a median-priced home. That price, by the way, is around $422,000. You got that lying around in savings? Statistically, you absolutely don't. The Fed says that the average savings for Americans under 35 is around $20,500. But because the ultra-rich heavily skew that math, far more than half of young Americans actually have even less than that. It feels like a slap in the face when most people are carefully budgeting just to stay afloat, trying to balance their rent, groceries, and fuel that seems to get more expensive every time you fill up. Americans' median home price-to-income ratio has risen from 3.5 in 1985 to 5.0 in 2025. In 1985, your average worker buying a house is kind of like investing in a luxury car. In 2026, it's more like your average worker buying a private jet. Inflation is out of control, no matter what the government tells you. The biggest lie of all is that it's a burden the whole population shoulders equally. According to Alliance, prices have increased by 29% since January 2019, with a persistent plus 3 percentage point inflation gap, or PPS, between low and high-income households. Even more disturbing, 1 in 3 low-income households spends about 95% of their income on basic needs. Given that so much inflation is based around basic necessities like food and fuel, the families spending the most on those are inevitably the ones most impacted by price hikes. For people with elite income far higher than the median, 16% of their spending is on discretionary goods and services. That's accountant speak for things that you absolutely don't need to buy. Compare that to only 12% of lower-income households. Those prices are the most stable under inflation, so high-income consumers suffer less, while median and low-income families get the full force of every economic disaster. To enjoy what used to be middle-class life, you need an elite salary now. All the math points to anyone in the lower middle class and below slowly sinking deeper toward insolvency. So why does the government and all the big banks act like everything is fine? Someone is telling a lie, and they are getting rich off of it. Part 2. The 9% Secret. While the government is often a lot more eager to turn your attention to the Dow or the S&P 500, the real stat we need to focus on here is the Consumer Price Index, or CPI. That is where the dark secret is hiding. In 2023, the reported Consumer Price Index for all urban consumers was 4.1%. But the Ludwig Institute for Shared Economic Prosperity noticed an inconsistency that could make all the difference. The Ludwig Institute calculates their own metric that cuts through the shadows gathered around the government CPI reading. It's called the TLC, or True Living Cost Index. Remember when we told you that higher-income households spend a lot more on non-essential outcomes? The TLC calculates the brutal stress inflation puts on the lower 50% of earners by excluding all the discretionary purchases that bulk out the yearly costs of higher-income earners. Instead, we have housing, food, transportation, healthcare, childcare, technology, and miscellaneous items like clothing and personal care. When a large share of the 80,000-plus items tracked in the CPI are stripped away in favor of the basics, the picture for lower middle and working class households looks very different. Compared to the 4.1% CPI in 2023, the True Living Cost Index came in at 9.4%, reflecting the reality of essential expenses like housing, food, and transport. This was the highest annual increase since 2001, less than a decade before the 2008 crash, and right before the onset of the Iraq War. Ludwig said middle and working-class Americans are facing a growing economic crisis, struggling to make ends meet despite recent economic growth. The rising cost of living, stagnant wages, and a shortage of living wage employment is creating a perfect storm that threatens social and economic stability. But that's a gamble that the government and the banking industry is more than happy to take. It's your chips on the table, not theirs. This means that the middle class is bleeding spending power like it just nicked a major artery. As of 2025, people in the middle spending bracket make up only 28% of the total U.S. consumer spending market. That same group had 37% in 1992. By contrast, the purchasing power of the folks in the top 10% of earners making over $250,000 a year have filled in the power vacuum. They were 35% of consumer spending back in 1992, and now they're at 48%. Let that sink in. 10% of people in the country are in control of nearly half of all consumer spending in the U.S. That's more than just an advantage, it's complete domination. And the working class are only getting even worse than the dwindling lower middle class. They make up only 9% of consumer spending power, less than a tenth of the total. According to Mark Zandi, the chief economist at Moody's Analytics, lower-income households have seen their share of the economic pie decline, and that's going to continue. The system is picking your pocket right now, trading on your future, but maybe they've already sown the seeds of their own demise. Surely, if purchasing power outside of the top 10% collapses, then the housing market follows. Historically, that's one of the first cracks that drags the whole economy down. But it hasn't, and that reveals another trick the system is using to make things look stable when they aren't. Part 3. The Golden Handcuff Effect. One of the biggest lies you've probably been told about the housing market is high interest rates will crash home prices. Interest rates go up during periods of inflation. High interest rates have been known to reduce house buying prices in the long run. Confused? Good, the financial industry wants you to be. Higher interest rates lead to houses being more expensive, which reduces demand. Reduced demand leads, theoretically, to surplus supply, which in turn brings prices down. It's sound economics, unless the supply is tied up. The mortgage rate is one of the most powerful economic drivers in the U.S. A difference of even 1 or 2 percentage points means thousands in extra monthly costs for homeowners. The pandemic saw historically low mortgage rates that allowed a lot of people to enter the housing market and in the process dig in their heels for the next rate hike. 52.5% had an interest rate below 4% as of the second quarter of 2025. New loans leapt up past 6% back in 2022 and have remained relatively firm ever since. But for those with low interest rates, there's an incentive not to sell given that they're in such a cushy position. This is known as golden handcuffs, a positive situation for the individual homeowner at least, that destroys any incentive to sell. The people outside of the property market are denied a way in. The Federal Housing Finance Agency estimated that the lock-in effect has prevented 1.72 million home sales between 2022 and 2024. This is a nightmare that we don't seem to be waking up from anytime soon. So despite the lower demand, the price is kept artificially high because the supply of houses is now historically low, at least 14% below pre-pandemic levels. And as a result of these price hikes, we're even seeing listed houses staying on the market for longer, 62 days in late 2025, a week more than 2024. Cotality chief economist Dr. Selma Hepp says the lack of supply often creates a tight market, increasing the ratio of buyers to sellers. Markets with the largest scarcity of homes for sale continue to see the strongest price growth despite affordability challenges. For first-time buyers or those who must move, it creates a severe affordability challenge, locking them out of homeownership. Whether they're locked in or locked out of the housing market, there is no denying that the general public is by and large locked. But that's just one piece of the puzzle in a larger and way more terrifying picture. The risk of economic collapse didn't just disappear after the 2008 crisis. It mutated into something even worse. Part 4. The Shadow Bank Time Bomb. The past, present, and future of the economic nightmare rolling toward us is deeply tied up in the so-called shadow banking sector. The kind of volatility that triggered the global financial crisis used to play out in the open before the Dodd-Frank Wall Street Reform and Consumer Protection Act. It was meant to curb too big to fail and end taxpayer-funded bailouts, and protect consumers from abusive financial practices. Of course, it didn't end any of those things. It just moved them into the dark. Shadow banking prefers to call itself non-bank financial intermediation. The Financial Stability Board broadly describes it as, quote, credit intermediation involving entities and activities outside the regular banking system. And in those dark spaces outside of traditional banking, you would be amazed at the regulatory loopholes you can take advantage of. This is deeply tied to the rise of private credit. Where companies once went to banks for loans under strict rules and oversight, private credit shifts that lending onto private off-balance sheet style arrangements between non-bank entities, largely out of the public view. But here is the crazy part. The banks are still involved, they're just not directly giving the private loans. Instead, they provide financial backing to the private lenders. It made sense pragmatically. The Dodd-Frank regulations forced traditional banks to hold more capital to reduce loan risk and do more extensive checks on borrowers. It slowed the whole process down and created additional costs to lending. These aren't problems for private credit, and it shows. The industry has now risen to heights of $2.1 trillion and is forecast by BlackRock to hit $4.5 trillion by 2030. The major risk here is that without regulation and transparency, the whole market will rot from the inside out. The rest of us will be dragged down with it as it goes. Raghavendra Rao, a professor of finance at the University of Cambridge, has said, "Nobody knows what the true value of assets is these guys are holding. They're opaque. We have no idea what's going on in there. Hopefully there are no bad loans. But what if there are?" The root cause of the bad loans causing the rot from inside of the booming private credit industry is the method they use to value their loans. Mark-to-model. This method uses financial models to value investments rather than actual current market prices. That means rather than being an exact science, there's often a terrifying amount of guesswork in an industry that is deeply tied to the overall economy. It seems almost like they have no idea if the entities they're lending to will default on their loans or not. And there are still layers of this that we haven't even peeled, ones somehow even worse than what we've seen before. These shadow banks are making dead companies seem alive on paper by inventing and capitalizing on a new form of insidious debt. Part 5. The Zombie Economy. Beyond Meat Inc., AMC Entertainment, Sunrun, Five9 Inc. What do these businesses have in common? They're all zombies. When you look at the facts and the stats, you start to realize that we might be facing an entire zombie apocalypse and not even know it. A zombie company is a business that barely makes enough to pay interest on debt. To stay afloat, it has to take on new borrowing just to service old payments. Their borrowing costs are insane, and every day they creep just a little bit closer to insolvency. Seems like a pretty terrible condition for a company to be in. According to Deutsche Bank estimates, as of 2020, as much as 18% of publicly traded U.S. companies are zombie companies. It'd be tempting to say, just shoot the zombie in the head and get over it. But these zombie companies accounted for 2.2 million jobs back in 2020. As time goes on and the number increases as a result of inflation, the result will be even more jobs tied into these untenable undead businesses. Most of these companies need to resort to PIK, or payment in kind, repayment plans to try in vain to keep up with their mounting debts. Essentially, instead of paying interest in cash, those payments are rolled into the outstanding debt balance owed to creditors. This increases the size of the debt mountain that they're under, and it often guarantees a slow but sure demise. With so much of the economy in this position, it feels like we're witnessing a controlled demolition. A major pillar of the economy is slowly crumbling, but the private credit industry is trying to keep the disaster behind a curtain of silence. But don't fall for the shell game here. It's meant to pull the wool over your eyes and make you forget the danger that's creeping up behind you. While the corporations are playing pretend and extend, an entire generation is defaulting in silence, loading up the gunpowder for an economic explosion. Part 6. The Invisible Default. Is it a bug or is it a feature? Whether it was planned or not, the system only has one inevitable ending, creating a K-shaped economy that plunges us deeper into the world of the haves and have-nots than ever before. Once the collapse is complete and the lines are drawn, all that'll be left are the asset owners and the service workers. But what does any of that actually mean? The K-shaped economy is a concept for a society that is so lopsided that the richest Americans are responsible for half of the economy. On one side, the stock market is booming and discretionary goods are selling like never before. On the other side, people are choosing between filling up their gas tanks or their stomachs on a day-to-day basis. One slope going up, the other going down, like the structure of the letter K. And in our case, this divide is absolutely split along generational lines. Baby boomers hold $83.3 trillion in assets, over half of the total U.S. household wealth. They are the richest generation in history, averaging $1 million per person. Then there's millennials and Gen Z together, the biggest population block there is when combined. But between them, they've got $17.1 trillion, only 10.5% of the total U.S. wealth. And these generations also deal with more hidden debt traps than any of the previous ones, like the increasing popularity of buy now, pay later schemes. It's a whole new stream of debt that federal data doesn't even show. The system is brutal. It's unfair. It's designed to hollow out the middle and leave hardworking people penniless. Short of upending the entire thing and starting from a blank slate, your best chance of surviving the rising tide of financial horror is to move your money to the only places that the tide can't reach. So what are they? Part 7. The Survival Playbook. In the short term, if you want to get ahead of the collapse, you need to shift your portfolio to strong, inflation-proof assets that are out of the hands of government tampering. One classic investment for hedging inflation is gold. Problem is, gold isn't completely inflation-proof. When banks increase rates due to inflation, gold won't pay a yield on that interest, so it isn't the most profitable asset to hold. You could also broadly invest in commodities like grain, precious metals, electricity, oil, beef, orange juice, and natural gas exchange-traded funds. But this isn't without risk either, given that commodities can be an insanely volatile market even outside of the context of inflation. Demand and supply factors, which dictate the value of commodities, are extremely sensitive to worldwide geopolitical events, and we seem to be having a lot more wars these days. If you want to play your investment strategy safe, there's always the 60-40 stock-bond portfolio. However, these can underperform drastically over the long term compared to all equity portfolios. If by contrast you want to buy into the awful real estate market, you could invest in REITs, real estate investment trusts. This is a real estate pool that pays out dividends, but it can still leave you exposed to property taxes and to shifts in demand for other high-yield assets. As with anything in the investment game, there's never such thing as no risk, just less risk than an alternative. In the dog-eat-dog world of the hollowed-out economy, growth is no longer the priority. It's all about resilience, riding and surviving the wave while keeping your assets out of the hands of governments and shadow banking institutions. If you're lucky, you can get yourself and your finances out of the service world and into the world of asset ownership before the shockwave hits. But that window is closing fast. For all you know, the wave might have already hit you, and you don't even know you're bleeding until you've got no more blood left. Want to know more info that you'll need to survive our current economic reality? Then you can't afford to miss $200 oil. The world economy is obliterated. Or watch this instead.